The water beneath, REITs, aquifers, invisible control. To follow the incentives, go underground. On paper, a deed is dirt, fences, and a mailbox. In practice, it's also a key to the water below or the water delivered by a ditch miles away. In most Western states, groundwater rights are tied to land, surface rights ride on seniority, and both can be transferred, leased, or banked through legal pathways that predate the funds now using them. Buy a farm and you don't just get soil. You quietly inherit a claim on a river that might be 100 miles upstream or a pocket of the Ogallala, 1,000 feet down. That claim is where control shifts without a headline. Corporate buyers rarely stamp their names on the pivot tower. They don't need to. A limited liability company on a deed owns the well permits. A trust holds the shares of the LLC. A fund holds the trust. If you knock on the door to ask who's pumping, you'll meet a manager with a binder. The real decisions get made in a meeting where resource security is a line on a slide. Walk the high plains to see the stakes. The Ogallala/High Plains Aquifer props up about a third of U.S. crop and animal production. In counties across Kansas, Texas, and the Panhandle, the water table has been dropping for decades. Everyone knows it. What's changed is the pressure from rent targets layered on top of weather. High rent mandates reward crops that monetize the water fastest, irrigated corn for feed or ethanol, high-value vegetables on drip, over rotations that conserve moisture. When your lease escalates and your lender wants proof of capacity, you pivot on more acres and pump harder. The aquifer becomes collateral, not a commons. Meanwhile, in California's Central Valley, senior surface rights can make an orchard worth more as a water instrument than as almonds. Firms bought blocks during low-rate years, then watched Sustainable Groundwater Management Act plans tighten. The response wasn't to unplant out of caution, at least not first. It was to keep pumping under existing allocations, add wells where legal, and explore transfers, moving water from a farm district to an urban system for a premium. The portfolio reads orchard, the model reads option. The mechanics aren't exotic. Irrigation pivots and drip systems get booked as capital improvements. Leases stipulate that tenants maintain equipment and comply with district rules. But the meters, where they exist, feed patterns. A landlord sees flow rates and yields, then pairs them with futures prices and rent schedules. A strong year becomes a benchmark. The next year is judged against it, regardless of rainfall. The habit becomes extraction. Match or exceed last season's water-supported returns, or cede the lease to someone who will. In basins without strict controls, the paradox sharpens. Arizona's unregulated rural aquifers, for example, have drawn corporate-scale dairies and nut operations that legally pump hundreds of millions of gallons annually while nearby domestic wells run dry. Residents drill deeper. Farms install bigger pumps. The water level sinks like a closing fist. Local headlines tell the story through families hauling water in pickup tanks. Portfolio reports tell it through production resilience and asset performance. Water isn't just an input, it's collateral and hedge. In offering decks, you'll see careful phrasing, water-secure assets, proximity to conveyance, priority rights. Investors hear stability, managers hear flexibility. If yields dip, you can still borrow against the embedded value of water access, or you can pivot acres to a use that monetizes the right itself. Leases to cities, transfers within a basin, even speculative positions on future scarcity. The more the aquifer falls, the more the right to draw becomes a store of value. That's the quiet moral hazard embedded under the fence line. Leases can direct extraction patterns without ever mentioning the word aquifer. Rent escalators set targets that certain crops can meet only with irrigation. Expected production clauses nudge tenants toward water-heavy rotations when rain fails. Capital improvements clauses make tenants responsible for drip or pivot upgrades that once installed justify higher rent. The result is perverse. Tenants finance the very systems that lock in their obligation to keep pumping. Parallel to wells, data streams reshape behavior. Precision irrigation sensors and flow meters feed platforms owned or preferred by landlords. Contracts grant aggregated, anonymized rights to the data. Those words sound harmless until you realize what's being aggregated: field-level depletion patterns, response to drought stress, well performance over time. That intelligence doesn't just optimize farming, it optimizes asset selection and rent pricing. The owner of the data knows which parcels sweat water into profit most efficiently and which tenants can be replaced to unlock more pumping. All of this sits inside a legal maze that rewards those who can pay to navigate it. Water banking programs allow rights holders to store or exchange allocations. Transfer hearings weigh beneficial use against community impact. Seniority in prior appropriation states can trump local need. Funds hire counsel who speak the dialect of acre-feet and case law. Tenants hire someone who can make a phone call. In the gap, control consolidates. The person holding the shovel's handle gets told what's efficient, and the definition bends toward balance sheets. If you want a simple test for who holds power, follow a dry year through a contract. A tenant proposes fallowing a block to rebuild moisture and protect next year's yield. The owner cites rent terms and notes the possibility of a deficit mitigation clause. Pay now, recover later if weather cooperates. Weather doesn't negotiate. The grower pumps to meet rent and hopes insurance backfills the gap. Insurance checks arrive after the season. The aquifer doesn't refill on schedule. There's a broader export hidden in supermarket aisles: virtual water. When a water-stressed basin grows alfalfa or almonds for export, it's shipping thousands of gallons per pound embedded in the crop. The ledger doesn't call it a pipeline, but that's what it is: water leaving stressed aquifers in the form of food or feed bound for distant markets. Investors call it comparative advantage. Communities call it a slow bleed. To be clear, not every fund pumps without restraint, and not every landlord treats water as a slot machine. There are operators and owners who set caps, share risk in drought, and tie rent to sustainable yields. Some districts meter rigorously and enforce limits that force everyone to bend. But the financialized model, scaled across states and time zones, prefers rules that can be repeated across a portfolio. Repeatable often means extractive, because regeneration takes time that a quarterly report won't grant. The optical trick is that water props up returns long enough to make fragility look like strength. As long as a well can be deepened, a transfer petition filed, or a lease pivoted to a crop with a higher water-to-dollar ratio, the numbers behave. The signal of stress isn't a crash. It's a drift, falling water tables measured in feet, then tens of feet, rising energy bills to lift water, salt creep in soils, canals rationed, neighbors drilling deeper and hitting air. That drift is slow enough to ignore in a presentation and fast enough to empty a town's future. Unknown to many tenants, their leases sometimes include interruption rights on delivery from private ditches or third-party agreements that prioritize certain blocks when allocations tighten. Translation: in a crunch, some acres get water and others don't, not because of agronomy, but because a clause in a contract drew a circle around which fields mattered most to the owner's returns. A map in a file cabinet decides who harvests and who apologizes to a buyer. When the basin runs into a hard cap, mandated cuts, metered ceilings, or wells that simply stop producing, the paper logic climbs a ladder. Owners sell water-secure parcels at a premium and shed the marginal acres. Tenants on the wrong side of the cap face the end of leases with little leverage. Communities lose production, then jobs, then people. The portfolio rotates. The town shrinks. Here's the twist that ties back to your grocery receipt. Water turns a local problem into a national one through markets. A dry year in one basin triggers rent pressure and crop switches that ripple into regional supply. Processors widen their sourcing radius and adjust basis. Trucking spreads pinch. A dataset in a city shows resilient returns. A diner in a farm town posts shorter hours. This isn't fatalism, it's physics and contracts. The physics say aquifers deplete when withdrawals exceed recharge. The contracts say rent is due whether rain falls or not. When capital sits on top of both, scarcity becomes a financial input. That's the invisible control: water rights bundled into deeds, deeds bundled into vehicles, vehicles engineered to turn a falling water table into a stable investor story. While water props up returns, the securities machine above ground learns to slice the farm into tradable promises. That's where the risk multiplies in ways no well can fix. Slicing the farm: funds, REITs, crowdfunding, tokens. While water props up returns underground, the machine above ground learns to turn fields into slices that trade. Start with the most polished version, the Farmland REIT Roadshow. The deck opens with a map dotted by pins, coastal berries, Midwestern row crops, western orchards, framed as geographic diversification. The voiceover promises a rent dividend engine that behaves like apartments, but with seasons instead of months. It's tidy, long-term net leases, escalators linked to market conditions, modest leverage, predictable distributions. The farmland itself fades behind phrases like core plus strategy and operational excellence through tenant partnerships. It sounds like comfort. It functions like scale. Drill into how the pitch works. First, gloss the variability. Instead of irrigation risk, call it resource security. Instead of crop failure, call it tenant selection. Instead of local weather, call it portfolio balance. Then emphasize liquidity, public shares, daily pricing, analyst coverage. The draw is that you can tap out with a click even if the tenant can't tap a well any deeper. The dividend is the hook. The story is the shield. Private funds echo the model with thicker documents and softer disclosures. They raise capital in vintages, close the fund, and hunt parcels that fit a template. The template is financial, not ecological, a target cap rate, a rent escalator structure, a tenant with scale. A capable mid-sized operator becomes platform-ready. The fund's mandate, low volatility, steady cash, upside on appreciation, filters every decision. If the numbers sing, the soil can wait its turn. Crowdfunding arrived as a friendly cousin. Own a slice of a specific farm for a few $1,000s. The website shows drone video, a smiling operator, and a simple promise: your cash helps buy the deed, rent and appreciation flow back to you. The structure is an LLC per parcel with the platform as manager. On the surface, it's intimacy. Underneath, it's a miniature of the same fee stack: acquisition fees, asset management fees, disposition fees. The tenant's risk hasn't moved. The audience has. Then come the wrappers designed for speed. ETFs track baskets of public farmland owners or agricultural real estate indices. The point isn't yield, it's exposure with intraday liquidity. Exposure invites momentum. Momentum invites leverage, total return swaps, margin options. The distance from a field in Tulia to a keystroke in Singapore shrinks to milliseconds. The price discovery that's supposed to reflect value starts reflecting flows. Tokenization tries to go smaller and faster still. A 2,000 acre block becomes 20,000 tokens on a blockchain. Each token claims a sliver of the rent stream and the eventual sale. A secondary market promises 24/7 trading and global access. Smart contracts distribute rent in stablecoins. The barrier to entry falls, the complexity rises. Now a harvest delay in Yakima can ripple through a Discord server where traders debate whether to dump their tokens before distributions slip. The field becomes a chat room sentiment object. Listen to how the leverage cycle threads through all of this. Rising NAVs in a REIT enable a credit facility expansion. New purchases lift comps. Higher comps justify another upsize. Private funds repeat the ladder with subscription lines and asset-level loans. Crowdfunders borrow against platform equity to add acquisitions that sustain growth narratives. Tokenizers tempt with staking yields and synthetic liquidity. At every layer, fees reward assets under management and transactions over outcomes. You don't have to intend a bubble to build one. You just have to keep feeding a structure designed to grow. Regulatory gaps widen as the structures proliferate. Real estate exemptions keep farm funds out of bank-style capital rules. Tokens tuck themselves under Reg D or Reg S, marketed to accredited wallets with terms that read like alphabet soup. ETFs ride on existing exchange rules that weren't built to test whether a farmland index actually maps to productive value on the ground. Call the assets infrastructure, and you inherit leniencies designed for bridges. Add sustainable, and you inherit marketing that outsprints auditing. Oversight fragments, responsibility blurs. Meanwhile, sales language keeps soothing: programmatic acquisitions, disciplined underwriting, tenant diligence framework. The words are technically accurate and emotionally anesthetic. They imply a process that can't possibly overreach because it's so carefully named. But process can be a funnel pointed at a cliff. The pressure to place capital doesn't pause for a dry 5-year climate projection or a basin adjudication creeping toward cuts. A term sheet moves faster than a watershed plan. You see the strain in human moments. A fund wins a bid on a mixed-use block, trees aging out, row crops between them, a sagging pump station. The underwriting assumes a replant financed by the tenant, rent stepping up in year 3, and a cost share on a new well. The tenant nods because the alternative is losing the lease. Year 2 arrives with a heat dome and a groundwater allocation trim. The tenant sprints to install micro sprinklers. The fund keeps the escalator because the deck promised it. The well pulls sand by late August. The tree line dies back. The fund's quarterly still reads on plan. The tenant's ledger doesn't. Crowdfunding's micro-stories rhyme. A platform markets a pasture as regenerative ready, leaning on keywords to attract ESG-minded investors. The lease, however, pegs rent to expected stocking rates based on a wet decade. 2 dry summers later, the operator proposes rest and lower density. The platform manager cites the offering's return profile. The pasture gets pushed. The soil loses cover. Investors receive a glossy update about operational learnings and adaptive management. The check clears, the grass doesn't. Tokenization adds a behavioral twist. Communities form around tickers, not towns. Holders celebrate buybacks and floor prices. They swarm comment sections when a tenant posts about a tough season, interpreting agronomy through the lens of token performance. Managers learn to communicate like meme stock CEOs, teasing partnerships, hinting at new acquisitions, promising enhanced distributions. The farm becomes content. The content feeds liquidity. Liquidity feeds the thesis. The season still lasts the same number of days. In the background, banks and private lenders write facilities that treat land bundles like any other collateral. A covenant breach can trigger a forced sale across multiple counties. A redemption wave in a fund can force a manager to dump non-core parcels into a thin market. Those sales reset comps downward, compress collateral values, and rattle lenders. The loop that lifted prices on the way up runs in reverse. None of this requires fraud or flames. It requires a mismatch between the speed of capital and the speed of agriculture. There's another slice few notice: data securitization. Platforms aggregate field telemetry, yield maps, moisture curves, pump loads, and package insights for underwriting and rental pricing. In some cases, they monetize it directly to input suppliers or insurers. The tenant supplies the signal by working the land. The owner captures the option by refining the signal into a pricing edge. It's a quiet derivative built from a farmer's day. Supporters argue the slicing democratizes ownership and funds improvements. Sometimes it does. A cold storage build can cut spoilage. A drain tile project can heal saturated ground. But the machine's default is to treat improvements as levers for higher rent and richer multiples. If a tenant installs drip with their capital, a manager can package the upgraded asset into a premium sale, book a disposition fee, and move on. The tenant negotiates with the next owner or leaves behind a system that will ask the next operator to pump as hard as the lease requires. Regulatory fixes get proposed: standardized disclosures on rent-to-yield ratios, hard caps on leverage at the vehicle level, beneficial owner registries for land and water, stewardship covenants tied to lease tax treatment. All useful. None change the core incentive if price discovery remains driven by liquidity rather than productive value. You can rate a bond without changing the debt behind it. You can inspect a pivot without changing the aquifer beneath it. Here's where it gets interesting. The bubble logic mirrors housing even when the products claim they don't. Houses were sliced into tranches that looked safer together than separate. Farms are now sliced into securities that look safer in a basket than in a basin. In both cases, the story outpaced the substrate. In both, small misses, rainfall, rates, regulation, can cascade through structures optimized for stability. What nobody wants to say on a panel is simple: food doesn't clear through an exchange. It clears through a season, and a season can't be sped up by a redemption window. So the farm gets sliced into dividends, tokens, fee streams, data packets, and redemption cycles, until the people on the ground carry a stack of invisible claims layered above their heads. As long as prices rise, the machine hums. When the weather or the water or the rates say no, the hum turns into a shudder you can feel in town before anyone rings a bell on a trading floor. The housing replay: detachment, leverage, dominoes. You've seen this movie. In housing, prices sprinted ahead of wages while lenders stacked products that looked safe until they weren't. In farmland, land values sprint ahead of per-acre profits, while funds stack vehicles that promise stability as long as appreciation keeps doing the heavy lifting. Detachment is the first rhyme. When rent claims and NAV marks matter more than what a field can produce over a decade, the asset stops behaving like a farm and starts behaving like a chip. Stakes first. For operators, the gap between rent and realistic yield is a margin tax with no ballot. For towns, a rent-driven crop switch can pull water, spike inputs, and hollow payrolls. For everyone eating, volatility climbs into prices when the gap is paid forward through contracts. That's why detachment isn't an academic phrase. It's the precondition for the dominoes. Action as it unfolded. During the low-rate years, managers borrowed against rising marks to expand. Bankers offered facilities secured by portfolios whose values leaned on each other. Appraisers penciled comps set by funds chasing scale. Meanwhile, investors bought the story that farmland's drawdowns were mild and mean reverting, so paper exposure looked gentler than equities. Layer by layer, a system optimized for steady lines grew more sensitive to the one thing farmland can't control: the cost of money. Here's where leverage hides. It isn't just loans, it's expectations. Pension models build in 6 to 8% from real assets. Consultants slot farmland into that box. REITs target dividends that assume escalators stick. Private funds promise IRRs that assume exits at uplifted multiples. If prices pause, projected returns vanish even without a foreclosure. That's leverage through design. A flat year becomes a shock because the structure can't absorb stillness. This was the moment everything changed. Rates rose, spreads narrowed, credit lines that felt harmless began to bite. Managers lifted rents to protect distributions. Non-core parcels hit the market into thinner demand. Crowdfunders slowed redemptions. A couple of forced sales reset comps lower in counties that hadn't seen a discount in years. Lenders reran covenants. The feedback loop reversed, quietly first. Impact immediate and rippling. Operators found leases repriced mid-cycle under market update clauses. Some walked. Larger platforms absorbed acres, bringing capacity and lender comfort, but also more standardized terms. Local banks, less exposed to the REIT layer, tightened operating credit because collateral values softened. Processors widened basis to secure supply from a map that suddenly looked patchy. None of this made headlines. It made checkout lines pricier and towns thinner. Asset-backed structures amplified the wobble. Subscription lines on private funds had to be retired with cash from dispositions. REITs managed optics by swapping assets, sell aging trees here, buy row crop there, masking net pressure with motion. ETFs transmitted sentiment. A negative quarter pulled money out of baskets that owned farmland proxies alongside other real asset names, dropping prices for reasons unrelated to rainfall. The machinery of diversification diversified the shock. Behavioral slogans kept the pedal down until the curve bent. Land always goes up, and they're not making more of it. Insulated decision makers from uncomfortable math. Climate variance eats predictability, water caps are real law, and per-acre profits haven't kept pace with per-acre prices in key regions. A slogan isn't a hedge, it's an accelerant. Rate sensitivity delivered the next beat. As interest expense rose, funds shifted to preserve optics, cut distributions, lift fees where allowed, push tenants harder. The tenants had two tools: extract more from soil and water now or exit. Many extracted, some exited. Exits concentrated acres under owners who manage by spreadsheet. Concentration reduces shock absorbers. One mispriced rent policy from a large landlord can tilt a county. Meanwhile, global capital turned local signals into global moves. A sovereign fund trimming its real assets, sliced to rebalance out of inflation trades, sold a position in a farmland partnership. That triggered a redemption clause. The manager listed parcels in 3 states. Sales cleared below peak marks. An insurer watching the prints widened haircuts on its credit line to another manager. That manager announced a disciplined pause in acquisitions. Brokers in 2 counties called it a breather. Tenants called it uncertainty. What nobody knew at the time, data streams became a hidden domino. Platforms that priced rent using normalized performance penalized operators who conserved water in dry years because outputs looked low versus models. In the next cycle, parcels where tenants had extracted harder were labeled top quartile. Rents followed the label. The algorithm learned the wrong lesson. Detachment created fragility. Leverage, financial, behavioral, and contractual, made it brittle. Dominoes sat on tables in New York, London, and Singapore, but they fell into school budgets, co-op invoices, and repair shops on county roads. The housing echo isn't about subprime paperwork. It's about a system that confuses tradable stability with durable production and then discovers, late, that seasons don't compound on command. There's one more rhyme. In housing, originate to distribute diluted accountability. In farmland, acquire to allocate does the same. Fees accrue as assets move and scale grows. Consequences accrue where rain misses and wells cough air. When the next shock hits, drought stack, rates spike, exports snap, redemption windows will open faster than aquifers recharge. And that timing gap is where a market story turns into a grocery bill.